Hello, my lovelies. Come sit on the porch with me while the air is hot and still. The summer is a great floral hat. Today we're going to look at different types of life insurance and how you can use them for your benefit in estate planning. Life insurance is a contract between two parties, typically an individual and an insurance company. The company agrees to pay a sum of money upon the death of the insured to the beneficiaries in the policy. The aim is to replace the economic loss that would have occurred by the beneficiaries because of the insured's death. In exchange for the death benefit, the individual who purchases a policy agrees to pay a premium, which is just money to the company for a specific period of time. The right insurance carefully lined up with your plan can provide significant economic benefit and peace of mind for you and your loved ones. Say you're a young couple, you're just starting out, you do not have a lot of spare income, you'll be well served with term. Term insurance pays the death benefit only if you die within a specific period of time. For example, policy 20 years. If you die in year 21, the term has ended, there will be no death benefit. You die in year 4, the entire amount is payable. It's very insurable, much more than whole, and it's designed to protect the insured's beneficiary should premature death create economic hardship during that time. We recommend this for young parents all the time. Responsible young parents start estate planning when their children are young and they think, yikes, what if something happens to us? But they're still paying their mortgage, they're still accumulating the retirement funds. So we can create a trust for their children, we can fund it with, even $1 million is very inexpensive for a young couple, and they're just ecstatic that if the worst happens, the home can be paid off and the children can be set up for life. Now, if you're a middle-aged working professional and you have a growing needing family, you may want to purchase either a much larger term policy or even a whole life policy with a guaranteed death benefit as long as you keep paying those premiums. Unlike term, whole life insurance guarantees a death benefit no matter when the death occurs. There's no term out. The premiums now are typically higher because the insurance company maintains a reserve that helps keep the premiums at that same level all your life. And this reserve is an accumulated cash value that you can borrow against, you can cash out if you decide to terminate the contract before you die. There are different varieties of whole life that have unique features that can be customized for your particular situation. Whole life is important if there's a chance that you could maybe develop a chronic illness, maybe diabetes, cancer, that would disqualify you from obtaining a new term when your old term leaves. If you maybe have a large estate, significant assets, it would be difficult to sell or the family don't want to sell, such as a great business, family real estate, a first to die or a second to die policy is the option. These two types of policies can be used when an infusion of cash is necessary at the death of the first or the second to die of two individuals, could be a married couple, could be business partner. These are called survivalship policies, and they're useful when a couple owns significant real estate, they want to keep it in the family after the first spouse dies, and the family would rather pay taxes from the proceeds than raise the cash to pay the taxes by selling their property. So paying the taxes, sometimes we could buy out a deceased partner's business interest. And insuring two individuals instead of one costs less, hence the first to die and second to die policies. They can be term, they can be whole, depending on your needs. They can also be universal or variable. These policies are a little more complex. They vary dependent on interest rates and policy in underlying investments. So you can even have your long-term care, so important for us now, tied into your life insurance, giving you the best of both worlds. You have your long-term care, you don't need it, the policy is still payable on death. Bottom line, Life insurance policies come with a huge variety of options because you have an endless variety of circumstances. Your dream team, your estate planning attorney, insurance professional, and financial advisor can help you identify your risks, whatever you may be facing, and then using a carefully crafted policy, coordinate your needs with your estate plan so that everything is taken care of. One final tip on life insurance policies: keep the policy document, beneficiary form safe, visible, and discoverable with your other important documents. Billions of dollars in policies go unclaimed every year because families did not even know the policy exists. Figuring this all out can be confusing, but remember, you're not on your own. If you need an estate planning attorney, you've got me. If you need an insurance agent, a financial planner, I can help you work with the trusted professionals that me and my clients work with every day. Whoa, that was a lot on insurance. Thank you for watching, and I will see you next week for Lemonade on the Porch with Kerlin Walsh Law. Thanks and bye.